KPIT Tech delivered a quarter which was slightly better than what was estimated on almost all counts. You could argue that because of cross-currency mix of the business, there were maybe an issue or two here and there, but that is, not quite doing justice to the delivery that they have done. And in a quarter wherein we've heard mixed commentary in businesses which cater to the auto space and powertrain business. So let's get in Sachin Tikekar to understand how have the 9 months, arguably not just the last 3 months, gone, and what is the outlook like for 2024, if you will. Sachin, great having you. Thanks for taking the time out. Congratulations on a strong quarter in line with what you had estimated. And within those numbers, because we look at the headlines, but on the internals, were there some line items which were either stronger or weaker than what you would have thought of?
Good morning to you. Good morning, Neeraj. Pleasure to be here. Thank you so much. Yes, I have to say this has been another quarter that has been absolutely in line with our overall expectations. In terms of things that are in our control, I think things went as per the plan, whether it's on the engagement with the clients and the revenue side, as well as the profits. I think they're a little bit more than what we thought, but in generally directionally in line. Of course, we have no control over the foreign exchange, and we just have to play it by the ear and see how it goes. Sometimes it works in favor, sometimes it doesn't. So what has happened, one change that has happened is our mix of business. Over the last couple of years, the growth in Europe has been extraordinary, and now there is growth in Japan. So Euro and Yen are playing a broader role in terms of our revenue mix. That's the only thing that I can say. But overall, we are happy that we have had consistent growth over the last 14 quarters. And the plan is to try and stay on top of it.
Okay. Now, Sachin, I know you guys are conservative. So if you're saying 37%, that is what you will stick to. So I'm not trying to eke an answer out of you which you don't want to give. But I'm still trying to think of this. I read a brokerage note which says that while the growth has been front-loaded to first 9 months, they believe Q4 will have a strong exit as the effects of furloughs unwind and client conversations become stronger. Then I was looking at the numbers, Sachin. YOY 60, 37% growth. Quarter on quarter, you had an exceptional growth. If you deliver 37% growth in FY24, which means you will do a 3.83% YOY growth and a degrowth in quarter 4. I find it hard to believe.
That's a good point, Neeraj. And what I can say is what we have actually given in our commentary, that we will definitely exceed 37%. And let's just see, wait for another quarter and see where we are going to be at. Well, all I can say is we continue to be confident about not just the quarter 4, but hopefully for the next few years to come.
Got it. Okay, and I was going to come to that. So like I said, I didn't want to eke out any other answer from you, Sachin, but just wanted to get this perspective. Yeah. But forget the number. But the point that people are making, one, client conversations, which you yourself have said in the releases, are strong. There's this comment that the effects of furloughs would unwind and that might bring in more clarity as well. Are you seeing a sense of this? Can you describe this to us?
So I think the point that I would like to discuss is the furlough point. More and more of our businesses actually moved to fixed price, and furloughs actually have been playing a lot less role in the company. And there are a couple of things that are also in the place. So I wouldn't give too much importance to the furlough piece in terms of what happened in Q3 and what is likely to happen in Q4. However, what I would say is the client conversations are going really well, and we see profitable growth coming our way in the foreseeable future.
Okay. And just before I get to those client conversations, because that is what will determine the rest of our conversation, just want to mark this. So your fixed price project mix, as you mentioned, 54%, if I'm not wrong, in Q3 versus 49%, I believe, last year, same time. Now, two questions. One, you've told me that, therefore, furloughs don't have a large impact. It will not come up in our conversations again. But does this have a material impact on operational metrics as well? Because you've done better than what was estimated. Does one read into this as an attempt to create a new normal, or are these quarterly fluctuations?
By design, we are trying to do more and more fixed price. And the reason, Neeraj, is if you're able to engage with our clients ahead of the curve, understand their business problems, and then the expectation from us is that we'll provide technology solutions to solve their problems. Some of the things can be done. For instance, upfront consulting assignments can be done on T&M, but the expectation is we make a lot of investments in what we call platforms, tools, and accelerators, and they provide a win-win situation for our clients as well as to us when they are in the play. And with increasing usage of our tools and accelerators, it becomes important that we move more towards the fixed price than T&M. So it's the effort is by design, and we hope that we continue to increase our fixed price and little bit of a license business going forward. It helps our clients in terms of to shorten their time to market, and secondly, it's also cost effective for them, and for it's profitable. So in many ways, it becomes a win-win.
Okay, just trying to understand, is this EBITDA accretive, EBITDA margin accretive as well?
Potentially, yes.
Okay, so in some sense, are you guys trying to or move to a new normal in terms of operational metrics? Because hitherto, I remember you always said that you will maintain this band. You've kind of gone above this band. You've told me that this is an attempt, not in as many words, but maybe to create a new normal. So is the new normal over the next 2 or 3 years higher than what the normal band of operational metrics or EBIT margin or EBITDA margin was for you?
For the last 14 quarters, has been increasing, as you can see. And we always wanted to make sure that we are north of 20%. And now we are north of 20% when it comes to EBITDA, or north of 16% when it comes to EBIT. The thing is, as we engage deeper and deeper with our clients, we see more areas where we can potentially create value for them. And this calls for a lot of proactive investments. So that's one area where we will increase our spend as the margins go up. And that has been our sort of a strategy over the last several years. We now need to bring in sharper focus on that and make sure that we continue to create higher value by making proactive investments in what lies ahead of the curve. Neeraj, if that answers your question.
It certainly does. So we'll read into it as an annual thing goes, because quarterly you will probably make investments here and there in order to do what you just said. Point well taken, Sachin. One question on the client conversations and the nature thereof, because I've seen misses from companies, not necessarily in ER&D, but across segments. On powertrain, there is weak commentary around EVs, and here you're telling me that things look hunky-dory. In your opening answer, you said you remain constructive not just for FY25, but maybe for many years ahead. Tell us a bit about this.
The way we see things, Neeraj, is there is obviously in some parts. So let's talk about the EV part first. If you look at obviously healthy growth in terms of number of vehicles sold, electric vehicles sold in major countries across the globe. However, the rate of growth is likely to slow down a little bit, especially in Europe as well as in the US. And that will impact the production of the EVs to some extent, because the OEMs want to get rid of the inventory and maybe sort of recalibrate some of the numbers for the immediate future. The work that we do, Neeraj, is on creating production programs. It has very little to do with how much vehicles that they will produce. So given the kind of work that we do, there are new programs that are getting launched on electrification. And as the software-defined vehicles, the first version becomes a reality in 26, 27, they're also all going to be electric programs. So from that perspective, our work continues, not only for the programs towards 26, 27, but hopefully for the 28, 29, the second version of software-defined vehicles. So given that kind of visibility, we feel comfortable in terms of seeing growth in electrification. So that's the part on the electrification. Having said that, we also see an opportunity for us to grow in traditional ICE space. As more and more players spend more of their bandwidth in electrification, there are certain existing programs that one needs to take care of. And also, these engines are going to be there for a long time, and they need to be maintained and enhanced on an ongoing basis. So we look at that also as an opportunity, with some of our clients who are making a shift towards EV in a fairly aggressive manner.
Sachin, the other aspect that I read in a note suggests that the deal velocity, of course, and Chinese EV players' entry into the European markets means more business for KPIT. If this is so, could you explain why?
I think that has been the case for the last few years, to be honest with you, Neeraj. And it's not. I think there is just added pressure from the Chinese OEMs now. Our OEMs across Japan, Europe, and the US, they've been making that shift towards software-defined vehicle and electrification for quite some time. Some are further down in their journey, and some are trying to play catch. And that's where we actually come in. And our engagements with them has helped us to sort of grow in a consistent manner over the last few years. Now, the Chinese OEMs are very visible, especially in Europe and some of the countries in Asia and Latin America. And that is just adding a little more pressure on the existing OEMs. So it has actually helped us in the past. And as there is going to be more and more pressure, maybe there are other ways in which we can help our existing OEMs to remain competitive in their respective markets.
Got it. Okay, point well taken. Now, to some client or rather some specific deals or specific accounts, if you will, one of the things that you've stated that you've identified 3 new OEMs as potentially strategic, and you expect to see revenue accretion from these going forward. Can you tell us a bit about this?
What we do, Neeraj, is we work with, it's our T25 strategy. So we work with T25, and that's been our model for quite some time. And what we do is every year, twice a year, we actually look at refreshing the list, given what's happening across the globe. And usually there are 1 or 2 who sort of, for whatever reason, they are no longer part of the T25, and there is always an opportunity to add 2 or 3. So we always keep an eye on all the OEMs across the globe and keep sensing and scanning which are those 4 or 5 with whom we can engage and create meaningful value for them. In the course of this financial year, there are 3 that we have identified, 1 from the Americas, 1 from Europe, and 1 from Asia. And there have been several conversations, workshops, and some pilots that have been done with all 3 of them. So we do see at this point in what happens is typically it takes quite some time to really figure out what their pain points are and sort of what are the ways in which we can actually build a long-term strategic partnership with them. This is important to us. Just doing one-off projects and programs doesn't make sense for us, because that it doesn't put us in a position where we can create tremendous value for them over a period of time. So they want to get to know us to see whether we are going to be their long-term partner, and we also want to see whether, is this partnership going to be long-term and valuable, mutually valuable to both. So that's what we've been doing with them during the course of this year. And we believe that there will be some growth that will come from all three of them, because we'll do some programs and projects with them. Only time will tell whether there will be an inflection point with some of them over the next few quarters. That's hard to say at this point in time, Neeraj.
Point well taken. Is the advancement on the middleware piece, wherein you have this JV with ZF as well, you mentioned, I believe, some mentions about commercial vehicle revenues as well. Is that also difficult to call in a volatile environment like this, or do you have some clarity there?
So let's talk about the middleware, the product. It's a separate company called Quarix, where ZF and KPIT are the investors. So it's now sort of taking its own form and shape as a separate entity. And then there are certain legal things that we need to overcome in the next few weeks, but we'll have that in place over the next few weeks. But it's actually come together, and it's acting like an independent company. And in terms of the development of the product roadmap, it's going as per our expectations. And what it is going to do is going to do two things. One is, as Quarix, the middleware platform, gets sourced by some of the leading OEMs, KPIT will act as the software integrator for them. So there are a couple of conversations that are on the way, where the Quarix middleware has been discussed with a couple of the OEMs. And naturally, if and when that happens, KPIT will be the software integrator for that middleware. So that's where we are on the middleware and the Quarix front. As far as the commercial vehicles is concerned, more than 20% of our business actually has been coming from commercial vehicles, largely from trucks. And there is a realization that in terms of technology, there are similarities, but in terms of the business and the applications, they are very different from passenger cars. And what we are trying to do now is really understand the business of the commercial vehicles, especially trucks, and see how we can use our technology to make them competitive, or get to their realizing their strategy. That's the part that we have started to double down on during the course of this year, and we believe that this will bring sharper attention, hence growth going forward. That's one part of the commercial vehicles, which is on highway, the trucks part. The second part, where we are slightly behind, but we have started to make some investments in, is the off-highway piece. Whether it's agro or mining equipment, that's going to be, but that, to me, it's to us at least, that's a let's say a 2 to 3 year kind of time horizon before we start to engage with our clients in a more meaningful manner.
Does this
so that's the story on commercial vehicles.
Got it. So do either of these, right, with middleware or this thing, have the potency, and that's my last question, Sachin, have the potency to become much larger than what they would be currently, or it will be a steady state kind of a growth that could be anticipated? I mean, again, could there be an inflection point into either of these?
Oh, absolutely. I mean, if you look at middleware, in some ways, I think we are already engaging. So from their production program 26 perspective, middleware can be part of it, but it's kind of, in terms of timing, it usually requires 3 to 4 years of planning. So it's going to be a little bit of a touch and go, but we hope that we'll have at least a couple of production programs for 2026, 27. The real, the 2.0 of SDV middleware, which is expected between 2028 and 2030, that's where there is an opportunity to have that inflection point, Neeraj. And the work for that has to start maybe 3 years or 4 years in advance. So that's the that's the answer to your question about the middleware piece with Quarix and software integration of KPIT. On the commercial vehicles, yeah, that's absolutely the effort. We want to make sure that we believe that the passenger car business will continue to do well in the foreseeable future, next 3 or 4 years. We'll need another growth engine to supplement that beyond, let's say, 27, 28. And we believe it, natural sort of adjacency for us is commercial vehicles, where most of the technology becomes relevant. It's just that the business applications are different. So first with trucks, because we have existing clients that are already part of T25. For off-highway, there is more work to be done. Neeraj.
Got it. Time runs by. We haven't discussed Renault. We haven't discussed anything else that you've done recently, but well, maybe we'll save that for the next quarter. But Sachin Tikekar, thank you so much for taking the time out and speaking to us. Appreciate your time and all the best for the quarters ahead.
Thank you, and it's always a pleasure, Neeraj.
Likewise,
Take
Sachin.
care.
And viewers, thanks for tuning in.
Okay.